The AMC Moass may be closer than anyone does realize, and keep in mind these are only my opinions, but we're going to be going over the factual information that you guys need to know revolving around the pop in AMC that we did see yesterday. A lot of people are saying this is really trading algorithms, and that doesn't make a lot of logical sense to me. We're going to be going over why that doesn't make sense, as well as the fact that hedge funds and institutions are buying AMC stock yet again, like we did see throughout the second half of May leading into the rally in June. We also have to talk about the fact that credit agencies are basically forecasting a downgrade to America's credit and what that does cause for the overall markets. As we do know, if the stock markets take a dramatic turn to the downside, we are looking at the potential, a very increased potential for the AMC short squeeze, and that is really the missing puzzle that we have needed for a long time, and apes are pretty much in a unanimous agreement that that is what we need to send this home. So let's get into this video. Tap, tickle, touch, or smash the like button. Consider subscribing to the channel. Hit me down below in the comment section. Let me know what you think about all of this information. Provide your guys' inputs. What is your timeline for this? Personally, I do not care how long it takes, but the information that I'm going to be showing you guys in this video really leads me to personally believe this will happen by the end of the year. But if it does not, this is only a patience game. It is a time game, right? Think about this. I say this all the time. If you had a winning lottery ticket that you knew was a winner, hundreds, thousands, millions of dollars, would you give your ticket away if you could not scratch it that day that you bought it? But you somehow knew as a winner, you would not give that ticket away, throw it in the trash, or send it back to the store. You would not do that. It is a time game with AMC. But let's stop rambling. Let's get straight into this video. And first things first, let's acknowledge the move that we did see yesterday. We've seen a phenomenal move to the upside, including after hours. We were up about 9%, but we did go from about $33.74 at the low end to about $41.50 at the higher end. So that was a move of over $8 per share. It was a very violent move. At one point, I was even questioning if shorts were covering, but everything really has pointed to that is not the case. We are seeing a lot of hedge funds, institutions coming in and buying the stock as per the 13F filings that are being reported. We're seeing much more for the month of September. Firms that are buying the stock compared to selling the stock, only a couple here and there that are actually selling the stock. But why do I think this was not a trading algorithmic type boost to the upside? And that comes down to the fact that Adam Aron's tweet came out 23 hours ago. This was after the market did close. I was filming a video when this did come out at about 6 o'clock. So this was not trading algorithms. The way that that does work is, yes, you do see pops based off of trading algorithms trying to price in news events, because if something is a big news event that is a game changer for the companies, the trading algorithm will get ahead of it first. So you'll see that big initial pop. If you see the follow through, that's really where you're starting to get more traders coming in and buying the stock, or just long-term investors that like the news that want to buy the stock. And that is exactly what we've seen. We did not see a pop, lock it, and drop it. We seen the price go up and then continue to leg up, and then we did see a slow meltdown after that. Probably a lot of traders that were day trading or swing trading this, as well as hedge funds, institutions buying into the stock. I think that is the main driver of the move that we did see yesterday. And the main point that I do want to get across is this is going to be very explosive, and it's going to be a lot harder for you guys to hold on to your positions when you're substantially up on them rather than when you're down on them. At least from my experience, it's a lot easier to hold a position, say you're down 50% on or 30% on, because you're like, at that point you've already lost a substantial amount. Why not just hold on to it and wait for it to come back, rather than you're up, you've printed massive tendies already, you don't know how much more upside there is, you start to freak out, you take it off the table, and then you end up buying back in. AMC is not really a stock that I would be doing that on. Like I said, feel free to do what you guys want. It's your money. This is not financial advice in any means necessary. Let's get more into the facts of what is going on with this whole credit downgrade situation. So we come to this article that is on Market Insider. It says Congress debt ceiling game of chicken has rating agencies sounding the alarm. S&P could slash rating to D on a default, while Fitch also warns of downgrade. If our credit goes from AAA to a D if we did not default, you are looking at a major market crash. But historically speaking, we have raised the debt ceiling 80 times in the past, so that is likely not going to happen. That is a very small chance. I would think about 15% chance, 15% chance this would actually happen, more along the lines of about a 15% chance, depending on, what they are trying to pass as well as the debt ceiling. If the debt ceiling bill just goes to, the Senate and the House by itself, it will likely get passed. If they're trying to attach a bunch of other things to this bill, it may not get passed. But nobody wants to see our credit rating go to D. That is something that would be very hard to come back from and likely take a very long time. It says, while Fitch also warns of downgrade, and Fitch loves to downgrade the American credit for whatever reason. They have done this plenty of times in the past. In 2013, on October 15th, the credit agency Fitch warned that it might cut the U.S. credit rating, citing the political brinksmanship over raising the federal debt ceiling. On October 17, 2013, I can't even say that, Downgrade global credit rating downgraded the United States from an A to an A- and maintained a negative outlook on the country's credit. Now, these type of credit downgrades, they play right into the stock market, and you will see the stock market going down. In fact, right here, Moody's and Fitch also dropped their outlooks for U.S. credit to negative in 2011, but neither agency cut their ratings from AAA. The rating cut triggered a 6.6% drop in the stock following on the next Monday. So we've established what a credit downgrade would do to the markets. Even just having our credit rating go from a positive to a negative would be a huge impact to the stock market. And considering where we currently sit with the overall markets, yes, we did see a very strong day today. The S&P going up 1.19%, in after hours up 0.12% as we currently speak. But we are still substantially down from the highest point we did see at $454.05 on the S&P 500 ETF. Now, we did close over this 100-day moving average just barely, but we are not out of the danger zone yet. And if we do get one of these downgrades while we are still at this danger zone at about the 100-day moving average, you will see a lot of selling power going into the markets. You'll see a lot of trading algorithms start to sell their stocks, especially since a lot of investors, most investors, are still substantially up in a lot of their long-term positions. Now, once we get out of this danger zone, it'll really be once the debt ceiling crisis has went away, they have raised the debt ceiling, we no longer are in seeing those fears of potentially seeing a credit downgrade or just defaulting altogether on our debt. But once we are well above this 50-day moving average, probably in the middle of, at about $450 on the S&P ETF, or, about $447 on the S&P ETF, that's where you're out of the danger zone, like I said, once the debt ceiling has been raised and those fears are off the table. So anything can happen at this point. We could default and see the markets go down 30 to 50%. Or we could see the debt ceiling get raised, by Monday. It's really hard to tell with politics, so a lot of this is going to be revolved around politics. Now, if you guys are unfamiliar why a stock market crash would cause the AMC short squeeze, it simply comes down to the fact that these hedge funds that are short on AMC, they have very large portfolios. The largest short positions of AMC are, millions of shares. It's no secret on that. I believe 12 million shares is the largest short position. But take somebody like Citadel, for example. This is something I've called out many times. If you look and see how big their portfolios are hundreds of billions of dollars. And going from even 2020, most hedge funds have at least doubled their portfolio values. So they have plenty of ammo to stay in these short positions. But once their portfolio values go down substantially, as we do know, they're over leveraged on margin. That compounds their losses on top of that. So say their portfolio went down 50% and the smallest shorts did start to cover, driving the price up. These bigger guys like Citadel, the top short position owners of AMC, will not have enough capital to remain in their short positions. That is very important. That is something you guys need to be fully made aware about. Now, there's no necessary time frame that I could put on this. Like I said, a lot of this revolves around politics, but I do personally think if we do get a credit downgrade, that will compound with everything else we're seeing, the growth slowing down, as well as just the markets are in a pretty fearful time frame right now. So that is what we do have for this video. Hopefully it gives you guys some perspective on what we are currently looking at. Watch for the latest developments on the debt ceiling. That is what has really made the markets very, very fearful. Evergrande is going to be something that will come up probably in the next 20 days or so if they don't end up paying on those bond notes. About $400 million worth they have to pay on. They have a 30-day grace period, which should expire by the middle of October or the later end of October. So that is going to wrap this video. Let me know if you guys agree with what I am saying. If you guys have anything to really argue with this theory, let me know that information down below in the comment section. I think all opinions are valuable, and something that I like to try to understand is why somebody would think differently to my opinion. So let me know that information down below in the comment section. Like the video, subscribe to the channel, all that good stuff. Help push this video out to as many people as possible. Also, check out the links linked down below in the description if you guys want to support the channel. Link for Public, link for Webull. Get free stocks with both of those links, as well as if you guys want access to all of my trades in real time, as well as talk to me one-on-one basis. Check that out. We keep it very inexpensive, so anybody is financially able to join if they want to grow their knowledge with trading and investing for the long term, for day trades, swing trades, or long-term investment with stock options or crypto. So that's going to conclude this video. Hopefully you guys enjoy your weekend, and I will see you in the next one.